Hello everyone, welcome you all to the investment management class. Today I am doing problems on alpha calculations and beta measurement. We have done it. So next further problems on the CAPM and SML. So in the previous session we have understood about the Sharpe index model, how you apply for the calculation of the return. So that we have did it in the previous session. So moving on, next is problems on CAPM and SML, security market line, and CAPM stand for capital asset pricing model. So here these two models helps us to understand the stock market behavior to the investors. So investors can easily understand the stock market behavior by applying these two models. So these two models are interrelated. So in CAPM we can see SAPM, okay, in CAPM we can see SML. Fine. So moving on to the question paper problem, that is from the question paper December 2011 question paper. It is question number 4A. It's a 10 scheme question paper. I just read out the question paper. I read the question, you just go through that. A security has a standard deviation of 4%. The correlation coefficient of the security with the market is 0.8, that is coefficient, correlation coefficient, and market standard deviation is 3.5. The return on risk-free security is 12% and from the market portfolio is 16%. So what is the required rate of return? What is the required rate of return which carries 3 months? So here we apply the CAPM model, whichever we have solved in the preceding previous sessions, that is valuation of security. So same formula we are going to apply here also. So we apply a CAPM formula for the calculation of expected return, that is expected return or required rate of return, whatever it may be, in terms of CAPM, that is equal to RF plus beta into RM minus RF, where RF is equal to risk-free rate of return and B is equal to beta, RM is equal to return on market portfolio minus RF is as usual risk-free rate of return. Okay. So here first you write down the given values. Okay, the given values first you write down. So here they have given standard deviation of 4%. They have given standard deviation of stock. Standard deviation of stock is how much? 4% they have mentioned. Okay, and also they have given the R, that is correlation. The R is equal to how much it is? 0.8. The R is equal to 0.8 and standard deviation M, that is risk on the market portfolio is how much? It is 3.5. Market standard deviation is 3.5%. Yeah. Next, the RF, that is risk-free rate of return, is 12%. We got 12%. Then RM, that is return on market portfolio, is how much? 16%. Okay, so they have given the available information like this. Okay, so here in the problem they have not given the beta. So in the previous problems we have got the beta in the problem itself, then based on that we have solved the expected return or required rate of return, isn't it? So here we apply first beta calculation formula, then we are going to do expected return or required rate of return. Okay, so first what is the formula for calculation of beta? So we have a formula for calculation of beta in the CAPM model. So first we have to find out the beta, that is beta is equal to standard deviation of the individual stock, divided by standard deviation of market into R, that is correlation. We have to apply this one. Okay, so here the standard deviation of particular stock is 4. isn't it? So we have 4% and standard deviation of market is 3.5 into R. R is equal to how much? That is 0.8, isn't it? 0.8. So how much will get? Calculate. 4 divided by 3.5 into 0.8. So you will get 0.91. You will get 0.91. This is the beta. So after finding the beta, moving on to calculation of the required return or expected return. How much? RF is equal to, we have got it, that is 12. Okay, so we got 12. Beta is 0.91. Okay, RM is equal to how much? 16 minus 12 again. Do it. Four into 0.91. So we will get 3.64. 3.64 plus 12 if you do, you will get 15.64%. 15.64%. This is the required rate of return. The required rate of return is 15.64. In this problem, beta they have not given. First find out the beta, then calculate the required rate of return. Hope you understood, which carries 3 marks. So, same related problems for 10 marks we can take it from the same question paper. Okay. Same question paper. The question number is 4C. So, this question is 4A, 4C. I just go through that. After a thorough analysis of both the aggregate stock market and the stock of Zenith company, you develop the following opinion. You develop the following opinion. So, they have given the economic conditions in terms of good, fair and poor. Likely returns they have given aggregate market and particular individual company Zenith company, and probability also they have mentioned. Okay. Then at present the risk for rate is 7%. You are using CAPM, calculate the required rate of return of Zenith, and would an investment in Zenith be wise? They have asked, which carries 10 marks. Okay, same. 0.2, y minus y bar is 7.8 into 0.4 probability. You will get 13.104. Next second one, 0.8 into x minus x bar is 0.2 into 0.4. So, we will get 0.064, 0.064. Last one, that is minus 17.2 into x minus x bar is minus 8.8 into 0.2. So, we will get 30 point, wait, I will just do once again, 17.2 into 8.8 into 0.2. We will get 30.272. 30.272. Okay. Then total of this you have to do 0.064 plus 13.104. We will get 43.44. 43.44. This is called covariance. This is called as covariance of x, y, 43.44. So, then find out standard deviation of x and standard deviation of y. Find out standard deviation of x. So, in the second unit we have solved the problems on the risk and the return, isn't it? So, same formula you have to apply, that is standard deviation of x is equal to, what is the formula? Root sigma p into x minus x bar whole square. So, standard deviation of x, how much it is? It is 22.56. Root of that we have to find out. Okay, 22 root 22.56. So, we will get 4.75 approximately. We will get 4.75. This is the standard deviation of x. Same thing you do it for y, that is sigma p into y minus y bar whole square, root of that is 83.76. Excuse, 83.76, root of that. So, you will get 9.15. 9.15. This is the standard deviation of y. So, we got standard deviation of x and standard deviation of y. We have found these values. Understood? Fine. So, next we can move on to calculation of r, then calculation of beta, then last CAPM required rate of return. Okay. Hope you understood. So, continuation, I will rub the board. Please write down quickly. That is, next moving on to calculation of R, that is correlation. They have not given in the problem. Correlation is equal to covariance of x, y divided by standard deviation of x into standard deviation of y. Isn't it? We have to apply R is equal to covariance of x, y divided by standard deviation of x and standard deviation of y. So, go back to second unit, remember the formula. Okay. So, standard deviation covariance of x, y is 43.44 divided by standard deviation of x is 4.75 into y 9.15. Do the multiplication. Do it. So how much will get? You will get approximately 1, 0.9999 you will get. So approximately will get 1, 0.999 or 1, you can take it. Okay. So approximately will get 1. So then moving on to calculation of beta. Beta is equal to, what is the formula? So here formula will change under CAPM beta calculation. We have to apply, that is standard deviation of y divided by standard deviation of x into r. Standard deviation of y is 9.15, x is 4.75 into whole into 1. 9.5 divided by 4.75 whole into 1. So, we will get exactly how much? (9.15) divided by 4.75 whole into 1. We will get 1.93. 1.93, you will get it. Okay. Then apply the formula of CAPM return, that is equal to RF plus beta into RM minus RF. Apply this formula. Okay. So RF, they only given in the problem how much it is, 7%, plus beta just now we have found 1.93, plus RM is equal to how much they have, how much we have found, x. RM is equal to x bar. RM is equal to x bar. In the preceding table we have found x bar how much, 11.8 minus 7 again. If you take, so how much you will get? Do the sum of that. 11.8 minus 7 into 1 point, it's not plus, into 1.93. So we will get 9.264, 7 plus 9.264, that is equal to plus 7. If you do, you will get 16.26%. The CAPM return is 16.26%. This is how we have to solve the problem on CAPM calculation. Got it? Fine. Moving on to the next problem, that is from the question paper, that is problems on SML. It is December 2012 question paper. It is question number 6C. Go through that. They have given the like information in the table, security expected return, beta and alpha. So for the data given above, that is A, B, C, D, E, F security they have given, Nifty index they have given, treasury bill represent risk free rate of return. So expected return they have given separately, beta they have given, alpha, standard deviation they have given. Okay, so find the securities that are overpriced and underpriced, first question. Second question, find out the portfolio return and portfolio beta by assuming that the portfolio is constructed by using equal proportions. Then third question, what would be the expected return and risk if the portfolio were margined at 50% with the cost of borrowing at 9%. Okay. So, you just take the conclusion for the previous problem. Okay. So, what is the conclusion for that? Actually we got 16.24% return. Okay. Expected return is how much? In Y 12.8 something, 12.2%. Okay. So, if you go for the conclusion in this solution, it could be better to invest the money because expected return is 12.2, but the actual return is 16.26. So, investor can opt this security for the investment. This is how we have to conclude. So, then this problem solution you have to take it. So, we have to do this in terms of SML calculation, that is security market line. SML pertaining to SML security market line. So, the same kind of problem we have solved in the previous unit, but this is somewhat different. Separately we calculate the estimated return we calculate, and we say whether it is overpriced or underpriced, okay, based on the expected return. Then we calculate the portfolio return. Then we also find the portfolio beta. So, at the end we calculate whenever it is taken for 50% or 80%. So, on that basis also we do calculate. Okay. This is pertaining to SML security market line. So, here we have to find out the security market line. So, for that there is a formula, security market line return. Security market line return is equal to same whatever we have put it for this one, that is CAPM, same will be considered, that is RF plus beta into RM minus RF. Okay, same kind of formula we will apply. So, take a table here, answer to the first question here, take a table, that is calculation of which are the prices are overpriced and which are all the securities returns are overpriced or underpriced, we have to do it. So, we have securities here, securities from A, B, C, D, F we have. Okay. Then we have return, we have expected return, we have expected return, how much they have given? They were given 33%, that is 0.33. Next we have 0.13, then 0.26, then we have 0.12, then lastly we have 0.14. They have given. Then find out the estimated return. Find out the estimated return by applying this formula. Okay, we have to find out. So, here the risk-free return is 0.09 plus beta vary from one security to another security. So, we have 1.7 for the A security into market return, how much? It is 0.13 minus 0.09 if you do. So, how much you will get? Take it here only. So, you will get 0.158. Next, this is same for all security, only beta will vary
Beta is 1.7 for first one, next 1.4 we have, next 1.1 we have, then we have 0.95, lastly we have E, one more we have A, B, C, D, E, F, we have till F. Okay, 0.33, 0.13, 0.26, 0.12, 0.21 we have to take one more, 21, 0.14. Okay. That is how much we have, 0.95 we have, then 1.05, lastly we have 0.70. Beta they have given the problem itself. So calculate. So you will get second one 0.146. Next you will get 0.134. So you will get 0.128. So you will get 0.132. Lastly, you will get 0.118. This is the estimated return. So we have to remark it whether it is overpriced or underpriced. Okay, so it is 15.8% and we have estimated return of 0.33. So it is overpriced or underpriced. We estimated this, but we got estimated this one, but expected return is 0.33. So how do you rate? It is underpriced. Then 0.13, 0.146, whether it is underpriced or overpriced. I am hearing it is overpriced. It is overpriced. Next 0.26, 0.134, it is underpriced. 0.12, 0.128, it is overpriced. 0.21, 0.13, underpriced. Last one also underpriced. This is how we have to calculate the estimated return in terms of remarks. We have answered to the first question. Hope you understood. Okay, next moving on to second question answer. Second question. For that answer, what is the second question? The second question is, okay, what is the portfolio return and portfolio beta? Portfolio, first return you calculate, portfolio return. Okay, portfolio return will be represented in terms of ER. ER is equal to sigma weight and R, weight and the return. Okay, so sigma weight and the return we have to consider, we have to apply this formula. So here equal it is divided, equal it is divided. So equal means it is same, 1 by 6 we can take it, 1 by 6, equal it is divided. So 1 by 6 you take it, weight is 1 by 6 into so particular security return, that is expected return is 0.33 plus 1 by 6 into second one. How much we have? We have 0.13 plus 1 by 6 into third one. How much we have? We have 0.26 plus 1 by 6 into how much we have? The next one, that is 0.12. Okay, plus 1 by 6 into how much we have? We have 0.21 plus 1 by 6 into 0.14. This is A, this is B, this is C, this is D, this is E, and this is F. So put together, total you calculate. So total he will get 0.2, approximately you can take it 0.2. Fine. This is the calculation of portfolio return. Same thing you calculate portfolio beta. Portfolio beta represented as BP. Okay, that is BP. That is equal to sigma weight and beta. Sigma weight and the beta, equality is divided same as previous, 1 by 6 into beta of A. How much it is? 1.7 we have. Next 1 by 6 into beta of second. How much we have? We have 1.4 plus 1 by 6 into beta of C. How much we have? We have 1.1 plus 1 by 6 into beta of D is equal to 0.95. Next plus 1 by 6 into beta of E is equal to 1.05 plus 1 by 6 into beta of last is 0.70. This is A, this is B, this is C, A, B, this is C, this is D, this is E, this is F. So you will get how much? You will get 1.149. Okay, you will get 1.149. 1.149. This is the answer to the second question. Hope you understood. The last question, moving on quickly. That is, what would be the expected return and risk if this portfolio were margined at 50% with the cost of borrowing at 9%. Okay, so if 50% of funds borrowed with a cost of 9%, that is cash outflow, cash goes out. Okay, so that is return, the required return, how much it is? It's an outflow, what like it goes out, we have to take minus, that is minus 0.09. Okay, and 50% of the funds will be goes, whatever we have risk-free rate of return 9%, so that is 0.09 into 50% of that, that is you can take 0.50 plus we have standard deviation, that is expected risk of 0.20. Okay, that is 0.20. So do that, minus 0.9, 50 plus 0.20. So you will get 0.155. 0.155. Okay, so once we found the return, okay, that is return on portfolio or estimated return, whatever we have got, then find out the estimated risk. This estimated return, then find out the estimated risk. Apply the formula. RP is equal to RF plus RM minus RF by standard deviation into standard deviation of M into standard deviation of P. Okay, so apply this formula and find out. Yes, I'll take here, I'll take it here. RP is equal to how much we got? 0.155. We have got it, isn't it? 0.155. That is equal to RF is equal to 0.09. Hope it's visible. 0.09 we got plus 0.13 RM, isn't it? Minus 0.09 divided by how much we have. Standard deviation of M market is 0.2 into, we don't know the risk of this, we don't know the risk of the estimated risk, we don't know, that is we call it as standard deviation P. Okay, so then 0.155 is equal to 0.09 plus 13.09. 13. So you will get how much? 0.04. You will get 0.2 into standard deviation P. This is called as estimated risk. This we call it as estimated risk. Okay. Then we take 0.155 is equal to 0.09, 0.04 divided by 0.2 into, we will get 0.2 again into standard deviation P. So 0.155, okay, LHS and RHS if you take, if it is plus, it will be minus 0.09 plus 0.2. We have to take standard deviation P. Done? Then minus of this one if you do, you will get 0.065. Okay, that is equal to 0.2 standard deviation P. Okay, so standard deviation P is equal to 0.065 divided by 0.20 if you consider. So how much you will get? You will get 0.325. 325. This is how we have to do it. This is the answer to the last question. Hope you understood. Okay. Fine. Thank you so much.